Are you as clueless as me when it comes to investing? Things like 401ks, the S&P 500, Roth IRAs. If that's you, then today's guest is going to bring you so much gold and insight into how to get started in investing, some strategic ways to start saving for your future, and how to decide what to invest in and when, depending on your personal circumstances. This is part 2 in a 2-part series on making faith-based financial decisions. Part 1 was episode 32, where Emily Scott laid a foundation for faith-based money management. She went over things like setting a budget, the importance of stewardship, and other Christian principles to live by. Today's guest, Jami McCree, dives deeper into investments, how to get started with investing, what you should have in place first, where to find resources, and other wise tips for making the most of your money and getting a return on your investment. Enjoy. Welcome to the Anchored Decision Show. I'm your host, Lauren Black, the world's biggest overthinker turned decision coach, all by the grace of God. Now, I'm on a mission to help you make easier decisions, discover God's will, and live with purpose. Tune in weekly to hear real-life decision stories, expert insights, and faith-based strategies to help you navigate your decisions with confidence. So ditch your pros and cons list and learn to make better decisions without asking your mom or losing another night of sleep. Let's go. All right, everybody, we are back, and I am so excited for today's guest, Jami McCree. Now, Jami is someone that's local to me, and we've known each other since high school. So it's fun to have a local guest and somebody that goes to my church and just connects, though we are recording remote so that we don't have microphone issues. So yeah, Jami is a financial advisor based in Jensen Beach, and she lives with her husband and 2 young children. After earning her MBA, she started her career as a financial advisor trainee at Merrill Lynch in Stuart, Florida, focusing on financial planning and investment management for high net worth families. And over a decade of experience led her to earn the Certified Private Wealth Advisor designation, so that's CPWA. And in 2023, she took a leap of faith and joined the Chapman Capital Advisors to build her own book of clients. So Jami now works with individuals and families at all stages of life, particularly helping younger families make smart financial decisions that will have long-lasting benefits. So Jami, welcome to the show.
Thank you so much for having me. This is the first time I've done anything like this, so it's nice to be doing it with a friendly face that I know. So thanks again for having me today.
Yeah, no problem. I knew through connections at church that Jami was into financial planning, and she's very involved in the community and like donating some products and services to charity auctions and things like that. So I just love your heart and thought you would have a great perspective to share for my audience on investing, since obviously this isn't my suit of expertise. So I needed someone who could. And so as I had mentioned in the opening, that last episode, I had a guest that shared more of a general overview on how to get started with financial decisions, like setting a budget, how to start saving, how to approach finances from a Christian's perspective. But today I wanted to dive deeper into investing. This is a topic I've had people request. So they just want to know what they should be looking for in investing and how to approach it, and the difference between an IRA and a 401k. So Jami will be helping us with all of that. So Jami, let's just start off with, is there anything else in your story or your background that you want to share of how you even got into financial advisory and this field?
Yeah, sure. To be completely honest, I sort of fell into it. I was originally planning on going to law school, wanting to be a corporate attorney, and I went through a lot of questioning of whether that was really right for me. So I got my MBA. I decided I did not want to go on to law school. And so a family friend introduced me to somebody who worked at Merrill Lynch. They said, why don't you go in and talk to him? And I showed up at the office. He shakes my hand, introduces me to the branch manager, who sits me down in an empty office and says, here's a test to take. And I was thinking, wow, I thought I was just here to ask some questions. So I was sort of thrown into the fire, and they said, we'll hire you right now. We're trying to ramp up this training program. And so again, sort of luck, family friend, that I fell into that opportunity and I really liked it. So, here I was young, educated, undergrad, business degree, master's, and yet all of my friends who were just starting to get jobs were like, I guess I'm supposed to sign up for this 401k thing. I don't know what I'm doing. And it just was such a reminder that we aren't taught enough in school, whether that be high school, college, advanced degrees, on the basics of personal finance and how to invest. And unfortunately, for most people, myself included, if there's something I'm not comfortable with, or I just tend to ignore it, right? And do nothing because that's the easier thing. So I felt really empowered that I had all this knowledge and training and all my friends were coming to me and I was just helping them sort of get going in their 401ks or whatever, their investment journeys. And I really liked it. So I want to continue that journey of just helping young families get going early because the best thing when it comes to investing is when you have time on your side.
Yeah, yeah. I love that. I didn't realize that about your story. So let's dive into the topic. How do you recommend prioritizing different financial goals, especially for those whose money might be tight? So, retirement, debt repayment, saving for children's education.
Right. Nobody likes to hear this, but everything really does start with a budget. If you don't know where your money's going, you'll wonder where it went. And so I constantly find people who say, well, money's tight. I can't this, I can't that. And, maybe I can see what kind of car they're driving or other things where I can say, well, let's just go through it. Have you tracked your spending? And most of the time the answer is no. So understand where your money is going, step one. But then I know where my money is going. How do I prioritize those things of saving for retirement, college, debt pay down? And so I sort of have this financial order of operations, if you remember that from high school math. The first one being, if you were lucky enough to work for a company that offers a retirement plan like a 401k, most of the time there's some sort of employer match to that. Meaning, maybe if I put in 3% of my own paycheck, the company will then match it dollar for dollar up to a certain percentage. Usually that's somewhere between 3 and 6%. And so I tell people, number one thing, if that is an option for you, make sure you are taking advantage of that above anything else, because that is free money that you could potentially be leaving on the table. I'll see people say, oh, well, I'm doing 4 or 5%, and I will log into their 401k with them, and they don't understand. They think they're getting the match. I said, no, you actually have to do 6% to get the full company match of, X percent. And so even if we have to rearrange savings somewhere else, the goal is never leave free money on the table. So that's sort of step one. Know what your benefits are if you do have that opportunity and make sure you're taking advantage of it. Beyond that, the rule of always keeping an emergency fund, right? 3 to 6 months worth of expenses that you just have in liquid savings. So outside of retirement accounts, something that's in a savings account, it can be, a high yield savings. Synchrony Bank is a great one that's free to use. You can earn a little over 4% on just money that's not invested, but just earning a stated interest rate. But that's so important because it helps you be financially at peace, right? Knowing that you have that money that's not subject to market fluctuations, that's not tied up in an account that you can't access till retirement, but it's there truly for an emergency. And that's so important because without that, that's what tends to lead people into debt, right? They pull out the credit card for large purchases that they shouldn't be using. So an emergency fund helps avoid that. So once you've got those things going for you, right, maxing out, getting the 401k match, you've got your emergency fund, then you can start really looking at your debt repay down. So while you're doing those first two steps, you should always be making the minimum payments on your credit cards if you are carrying a balance. And if you do have debt on a credit card that's lingering and you're making those minimum payments, well, maybe after you've done those other first two things, you start paying the debt down quicker. I personally, there's different ways to pay down debt, believe in paying down the debt that has the highest interest rate on it to get that knocked down as quickly as possible. Once you've done those three things, you're not carrying credit card debt, then you look back and say, all right, where else could I be directing my money? A good rule of thumb is from whatever age, you should be saving at least 10% of your money every year for retirement. So let's go back to that first step. All right, I got my employer match, so I'm putting in 5% to get the full match. Well, that's great. You're putting in 5. The employer is also putting in 5. But if you've done those other things with your emergency fund, no debt, then where else could you save? You could increase your 401k contributions, maybe from 5% up to 10%, or you could do a retirement account of your own in addition to your 401k. So something I really recommend younger clients do is to have a Roth IRA that they can contribute in addition to that 401k and make sure they're getting that 10% of their income that they're making going towards their retirement accounts.
Yeah, definitely. So, can you explain the difference between a Roth IRA and a 401k?
So, again, not everybody has the option of a 401k. A 401k is something that your employer puts in place and offers it to employees. Sometimes it's offered to employees within 30 days of being hired. Sometimes they have to work at a company for a year or more before they're even eligible to participate or eligible for a company match. But that's something that your employer puts together. And for most people, the employer gives you an option to say, you can select a percentage of your paycheck to be withheld and go into the 401k account. And you can choose whether that percentage is pre-tax or after-tax. So many 401ks have the option of saving pre-tax or after-tax, which would be called like a Roth 401k. And so anything that your employer puts in for you that match is always pre-tax. But you could choose to do your 5% or whatever it is in the Roth part of the 401k. The company puts in their match pre-tax. And so the difference between the 401k and an IRA is the 401k is sponsored by the employer. And as far as the difference between pre-tax or Roth, pre-tax gives you the tax break now, right? Comes out before your income is taxed, versus Roth, you pay your taxes and then you're saving. And the benefit to a Roth is that later on in life, when you go to retire and you start spending down out of your retirement accounts, you're not paying any tax on anything that's coming out of a Roth account, be it whether it's the 401k Roth or an IRA Roth. So for people that are maybe just starting out or they're not in a very high income tax bracket, a Roth can be a great tool to help them save.
Right. So, I don't know much about this. This is somewhat new to me. So, I'm asking just out of my own personal curiosity too. If the interest rates rise, or, when you go to retire so much further down the line, that tax rate could be higher. Is that something, do you get grandfathered in at the current tax rate, or is it something where you have to pay higher taxes down the line if the taxes are higher?
Right. So you're not grandfathered in, right? And historically, we are in a very low tax era, if you will. With the outcome of the election, we are assuming that the current tax rates that are in place, they were set to expire, that they're going to continue at least through the rest of this administration. But for those who are younger, who knows what tax rates might be, when you go to retire. And so it's a strategy, and every person is unique. And so we look at total household income. If you're fortunate enough to be in a tax bracket now where you're paying at 34, 37%, while we might not know what the tax rates are in the future, we will say, look, our recommendation is let's get as much tax break now as possible. If you're sort of that middle of the road, 24% tax rate, then we usually try to split the difference, right? Like I mentioned, that company match will always be pre-tax, meaning taxed later on. So maybe you do the Roth on the side. So for people who are making great income, I'll usually recommend max out your 401k beyond the match, because there are no income limits to putting money in a 401k pre-tax. So if you're under 50, you are allowed to put in about $23,000 pre-tax into your 401k. And that comes right off the top line of your taxes. So saving you 24%, right? And so for people who are high income earners, those are the people that can save that kind of money annually. And then they could potentially also do a Roth on the side. There are income limits, but there are ways to sort of get around those. It's called a backdoor Roth. So that's why working with an advisor or even just consulting with your CPA, whoever's helping you do your taxes, there's lots of ways to try to maximize your savings in tax advantaged accounts. Both Roth and 401 pre-tax are tax advantaged, meaning money goes in and grows tax deferred. So every year, if you're earning 10%, you're not paying tax on that 10% growth in either account. So we look to maximize tax advantaged accounts wherever possible. And then based off of your current tax rate, we'll balance between save on tax now or save on tax later.
Right. Okay. And yeah, I like that you do suggest to have it just immediately come out of your paycheck. So that way, instead of having to look at your expenses and make adjustments to then start saving for retirement, it's as if you never had that money in the first place. So you're not setting your budget based around something that you don't have anymore.
Right.
Yeah.
You don't look at what's left over. So on the budget sheet, and there's no magic tool. I mean, when people are like, can you send me a budget? Sure. I go to Excel, the template. They've got 20 different templates. There's really simple ones for people who have varying income, simple income, and it's just a matter of plugging it in. And I put in, the savings. We don't look at all the expenses of your car payments and your groceries and all these things and then say what's left. It's, all right, I'm earmarking this as an expense, my savings. And so if you're, again, the 401k through a company, it's the easiest thing. You don't, because it never even hits your bank account, right? So you can't spend it.
Yeah, that's great. Hey friends, do you want to live life making intentional decisions grounded in your true core values, long-term goals, and deepest desires without the stress and agony of having to face every decision that comes up individually? If that sounds like you, then you need my free decision compass. This free PDF guide will help you gain clarity on who you are and how you want to live so you can predetermine certain decisions and priorities to save your brain power for the more complex choices. Because if your priority list is 10 items long, that's not truly a priority. You need to know what's the most important. This guide will help you set some boundaries and uncover your non-negotiables so you can make more personalized decisions for you, not based on everybody else's expectations of you. It includes a place to write your decision foundation statement, helping you live by your values, make easier yeses and guilt-free nos. Download your free decision compass now at anchoreddecisions.com/compass to set your compass on what's truly important. Now, back to the episode. So, how does age, income level, or financial goals influence someone's financial strategy? So, for say, if someone's middle-aged and ready to start investing at that point, how would their strategy be different than someone in their 20s?
Right. The biggest factor of success when it comes to investing is your savings rate. That's way more important than what actual investments you're choosing. So, without offending anybody, if we want to call 40-ish middle age, which I don't think it is. But there's a general rule of thumb that you should have about 3 times your annual income saved for retirement by the age of 40. So if you're somebody who's consistently made about $100,000 a year, then you should have about $300,000 saved by that age. And some of listeners might be going, wow, I'm nowhere near that, or I'm above that. Well, then if you're way below that number, that 10% for retirement, that's going to be different for you. You're going to have to start saving more than that and really buckle down on how much you're saving. And it's things like when you go to look at what kind of car you're going to buy. Yes, maybe you can afford the $900 car payment, but what if you made it, a $500 car payment and you saved the difference? The more time you have on your side, the less dollars you actually have to save. And that's the benefit of compound interest. And so the earlier you can save, and if you're doing that 10% number, you'll have a very secure retirement and be able to spend more in retirement than you probably did off of your earned income before retirement. As far as how the money should be invested at different ages, the longer your time horizon is towards a goal, the more aggressive you should be. And aggressive meaning more in stocks, right? When we think of a general portfolio, it typically has three components: stocks, bonds, which is like fixed incomes, CDs, and cash, right? And we look at the total portfolio. And so a lot of times if you're in, for example, a 401k plan and there's a set list of options they have for you to invest in. And almost every 401k has what's called target date funds. And so if you'll look at it and say, all right, well, if I'm planning on retiring in 2050, I'll just pick the target date 2050 fund. And that will adjust and actually make your portfolio less aggressive as you move closer to that date. And so somebody who is young and has a longer time horizon before they plan on using their retirement funds, then they should be almost 100% in stock. And as you get closer to your retirement date, that number should go down. A general rule of thumb, and again, I don't like making too many general statements, but when we get to retirement, a portfolio of about 60% stocks and the rest being in cash and bonds is very common. And so the younger you are, the more aggressive. And it also depends on the goal, right? I might consider myself young, but if I'm saving for my kids' college and my kid's only 5 years away from college, well, it's not my age that's the factor. It's when am I going to use those funds? And if it's only 5 years away, then I should not be as aggressive or as much in stocks as if my kid had 10 more years to college. And so every savings account, investment account should have a goal and a target of when am I going to use those funds? And that will dictate, the investment strategy within the account.
Yeah. So now how do you go about finding a good stock to invest in? I know I've watched my dad do stocks his whole life. At one point, he was into day trading, and then he's always been into the long term of researching companies, but he does a lot himself. And I know some people that depend on certain financial, like stock experts, and sometimes it leads them down a good path, and then sometimes they flop. And so does someone like you have knowledge and experience with stocks, or is there someone more specific that you go to that specializes just in stocks?
So for most people, we're using investment vehicles like exchange traded funds, mutual funds. So those are pooled vehicles. So instead of just necessarily picking an individual stock, you might pick an index such as the S&P 500 and buy an S&P 500 fund, because that's going to help the client be diversified. So and part of that reason, especially for younger people who might have a smaller dollar amount to start off, or they're systematically saving on a monthly basis. For example, there's lots of different funds out there that track the S&P 500. So the S&P 500 is a benchmark index for the U.S. stock market. It tracks, it's actually 504, I believe now, of the largest U.S. publicly traded companies. And so if you just buy that one fund, it's like owning over 500 different companies individually. So you're getting broad diversification, exposure to all these companies without having to try to pick which stock is going to be the best. And so there are lots of different ones out there. I will bring up the Schwab S&P fund because it trades at right now about $93. So that means if I'm somebody who is saving $100 a month into an account, I can set it up to just put the $100 in, buy that fund, and know that I have some of the best companies in the world in my portfolio, right? The largest holdings in that fund: Apple, Amazon, Microsoft, Google, NVIDIA. So you don't have to be this day trader trying to pick the best stocks. So for example, Facebook or Meta, that stock trades at $625 a share. So if you've got a small account, it's really hard to try to split up. Well, I'm going to buy a share of this, a share of that. I only have so many dollars that can go so far. So again, that's where age appropriateness and sort of the value of your portfolio comes into play. For some larger clients, yes, we will do individual stocks because they have that larger account balance where we can buy potentially 30 stocks in some index funds and get them broad diversification where we're buying different stocks from different areas of the economy. So different sectors, the technology sector, the healthcare sector, and we can buy individual stocks. And there's myself and two other partners I have. So we all work together to figure out which stocks are the best ones we want to fit in for certain clients based on their goals.
Okay, great. You can tell that my husband's the one that does all of our investing and finances
Yeah,
because that was all completely new to me. I did not realize that there were those kind of index funds or
right. They make life
whatever those.
easy, right? You
Okay.
don't
Yeah.
have to be um, very well versed or doing the research yourself. It is so easy to go on to whether it's Charles Schwab, Fidelity, E-Trade, these platforms where you can just systematically buy into index funds. They're very low cost and get this broad diversification. You don't have to be an expert. The S&P 500 is up 28% this year. That's a great return. Yes, if you had put all of your money into NVIDIA, which is in the news every day, you'd have a higher return, right? But that's not diversified. If something happens to that stock, if that CEO, something happens to him, that stock is going to take a hit. So when you have broad diversification, your portfolio is going to be much more stable in its fluctuations up and down because most people don't have the stomach to put, gamble all their money on one or two stocks. They can't afford to take that kind of risk. But unfortunately, whether it be social media or the news, everybody wants this get rich. I want to double my money in 2 months or, things like that. And the best strategy really is just staying in the market and investing consistently as your income comes in.
Yeah, yeah. Well, I know somebody that when my first job out of college, it was a newer company and they took it public, and one of the employees had invested a lot in the stock of that company. Plus, he was being paid in that company. And so the company ended up going bankrupt and shut down. And so he lost his job. And then he's like, and all my stocks were in that same company. So he basically was out everything all at
Right.
once.
And that happens a lot, right? People work for these companies and they, so to speak, drink the Kool-Aid and they're like, well, nobody knows this company better than me. I'm going to put all my eggs in that basket. And sometimes clients are sort of handcuffed, right? They might be getting these restricted stock units that they can't sell for a certain period of time. And so I will say to them, I get that some of your money is tied up in the company, your income stream, maybe these restricted stocks that you can't get rid of, bonuses, what have you. But as soon as those become unrestricted, I work with my clients to sell those off as efficiently as possible because you just can't have everything in one spot. I have a good friend, she works for Zillow and she loves the company, but I'm like, look, you have all these great benefits, but as these come due, we just have to buy other things. We can't have it all tied up to that because you never know what could happen.
Yeah. So now, when you were mentioning diversifying your portfolios, we're talking about, you did mention bonds and CDs. Can you go into some of those a little bit, just in layman's terms of what they are and what they mean?
Right. So, a stock, which more people are familiar with that term. Another term for stock is equity. So if someone says, I've got an 80-20 portfolio, probably 80% stock or equities, 20% cash and fixed income. So the fixed income companies, let's use Apple for an example, they issue stock where you actually have an ownership of that company. So as their earnings increase, stock price increases, and that's maybe they pay a dividend and you get some of that money back as a shareholder. They also issue what's called bonds, which can be thought of as a CD. More people are probably familiar with that. So they might say, you give us $10,000 and we will pay you a stated interest rate for 10 years, 15 years, 20 years, whatever the maturity of that bond is. We'll give you a stated interest rate for the time. And then at the end of that period, you get your money back. So let's say I put $10,000 into this bond. It's got a 5-year maturity. It's going to pay me 5% interest a year. And then at the end of the term, I get my $10,000 of principal back. So it's a very safe investment, but it's going to be a lower return than that upside potential you might get in a stock that might, go up 200% in a year. So when you own stock, you're hoping to get that price appreciation. And when you're owning something like a bond, fixed income, so bonds, CDs, you're owning it not for the price appreciation of the bond, but for that stable interest rate. And so that's why as you navigate closer to retirement, people will have more fixed incomes, bonds, and CDs in their portfolio because they're collecting that income and they want some of that stability in their portfolio because bonds don't typically fluctuate nearly as much as the stock market does. Now, they can fluctuate in price, but if you hold them to maturity, you'll get your money back. Of course, there's always the companies that potentially could go bankrupt. So there is risk to owning the bond that you may not get your money back. But most of the time, we're buying bonds from companies that are very well known, all the same ones I talked about in the S&P 500, Apple, Amazon, Google. So stable investments that generate income. So for those younger people that don't need income because they're working, they should have their money in stocks because they're going to get that price appreciation over time.
All right. So, Jami, this has been super, super informational and very helpful. Now, with so much information and access to investing online, what are some of the benefits of working with an advisor like you?
There's so much noise out there, like you said. So one of the benefits is really it's hard to get advice in a vacuum, right? So when people go to a friend, should I do this? Should I do that? They're typically not telling that person all their financial history of debt, whatever, what their income rate is. And so they're not getting the best advice. And so when I sit down with a client, I go through everything. So if somebody says to me, hey, I've got $10,000, what should I invest it in? I say, I have no idea. I have no idea what you should invest it in. I don't say, oh, go buy Google. I sit down and say, what are you doing? Are you doing the 401k things? Do you have an emergency fund? Do you have debt that should be paid off? And so it's working with an advisor helps you know exactly what you should be doing with your money. What's the smartest thing given all the history of things going on in your life, in your situation? So, I don't give advice in a vacuum. I don't give advice unless someone's willing to give me some of their background information and go through the steps of really knowing their financial lives. A great resource that I share with a lot of my clients, I keep referencing Schwab, so full disclosure, I use the Schwab platform for my clients, but clients can also have their own self-directed. Anybody can go on charlesschwab.com and open an account. There's a lot of great tools, and Schwab has a free website, so anybody can use it, Schwab MoneyWise. You can go to this website, and they've got all kinds of topics available to learn about in very easy layman's terms, right? What is an estate plan? Do I need a will? Do I need life insurance? What's the difference with term life insurance? What's a stock? What's a bond? And it's so educational and well written that I'm constantly encouraging clients to use that website as a resource, right? Because we can only cover so many topics in a short period of time, but there's also great calculators on that website. So whenever I sit with somebody, I've got it earmarked on my phone, this compound savings calculator, and I just sit there and show them, look, if you save X amount of dollars a month or a year, and for this many years, and we just plug in a historical average return of 10%, because that's what the S&P 500 has averaged, here's what you could have. And they're, oh, wow. Because it doesn't get exciting when you look at, well, I'm saving $500 a month and, a year or two goes by. But it gets exciting when you look at what could I have after all of this time. And so I'm always encouraging people to learn more, even on your own, because it becomes very hard to trust somebody like myself or any advisor. As much as I try to speak in layman's terms, I know a lot of times if somebody doesn't have a lot of background, they want to know more on their own. And so I encourage them to read, better understand it. I'll send them links, make sure they're really comfortable before we move forward with a strategy.
Yeah, that's great. So now, do you work with people online from anywhere or mostly just local here?
Online, anywhere. I've got clients all across the U.S., especially some of the younger people. Everyone's fairly comfortable with Zoom. We try to do most things digitally. I've got a lot of local clients because they're just people I know through life. But it's been my transition from Merrill Lynch to what I'm doing now is great because when I was at a big firm, we had very high minimums. So unless you had $500,000 that you could invest with me right then and there, I really couldn't open an account or help you. And now I don't have those minimums. So I'm helping people of all age ranges. And a lot of those people are people who are my age, right? And I can help them, you know, save according to their goals, prioritize that. I've got kids in college, I've got student loans, I've got my retirement. And so it's been nice to be able to work with people who are more in the same stage of life as me than just necessarily retired people. But yeah, so I'm happy to work with anybody and no matter where they're located.
That is great. I love that you're able to help people online and not just here in Stuart. So thank you so much for all that you shared today. Now, I always leave my listeners with an action step so they can take what they've learned and put it into practice. And so today's action step is to go set up an account with the Schwab Money Wise website. And that way you can start learning and growing and investing wisely. So thank you for sharing that resource, Jami. Let us know where people can find you, how they can connect with you.
Yeah, I am working on building my social media brand, but I do have Jami McCree at Chapman Capital on Facebook and Instagram, and I'm trying to start publishing more things that are just informational, like what's the maximum amount you can put in your retirement accounts and those things. But my website, I've got an office right down the street in Stuart, right by the hospital off of Osceola. So I'm happy to meet, grab coffee, set up a quick meeting online on the phone. We could do a Zoom face-to-face because a lot of people, of course, are working. And so I'll do a Zoom in the evening if that works for them. Just make it easy for people. But my website's chapmancapitaladvisors.com. That's got all my contact information. I give out my cell phone online so people can text me and just have it be really comfortable.
Awesome. Thank you. And for anybody listening, I will drop all of those links into the show notes so you can easily find how to connect with Jami. So thank you so much for sharing all of your wisdom today. I really loved having you on.
Thank you.
Yeah, of course. The pleasure was all mine. Now let me pray us out. Father God, I thank you so much for Jami and the wisdom she shared today on knowing how to invest and where to invest your money, on what to do ahead of time to make sure you are set up for success, and so that we can be good stewards of our money and be able to save for retirement and think of the future. So help us to make those wise decisions, to turn to the right resources like Jami so that we can be advised on what to do for our personal circumstances. And God, we pray for great returns on our investments and that you would lead us to the right places to invest, to the right stocks, bonds, CDs, whatever our circumstance is. So God, we know that our money is not ours anyway, it is yours. And we just want to be good stewards of what you have provided. So we lift these all back to you and we pray that our finances would be used for the glory of your kingdom. In Jesus' name we pray, amen. Thanks for listening all the way through. For more content on decision making and discovering God's will, hit subscribe so you don't miss an episode, or head over to anchoreddecisions.com for show notes and more content related to this episode. See you soon for another episode of the Anchored Decision Show.